Hello and welcome once again to the Smart Money, Dumb Money Show. And I am your host, Keith Richards. I am President and Chief Portfolio Manager at Value Trend Wealth Management, and I'm a technical analyst. Today, we are going to look at charts of world indices, and we want to do some contrast and compare, and we want to look at which countries we should be considering outside of our own little bubble of North America. And I want to start off, though, before I get into the stock charts, and show you a chart posted on a research report that I just picked up this morning. And today is the 27th of February, 2024. So you'll probably be seeing this video about a week from now. And this was a graph showing productivity in the G7 countries. So this is only 7 of the countries we're going to be looking at today when we look at all the world indices, but it's going to give you an idea of how sometimes fundamentals matter and sometimes they don't. We've seen this with perhaps some of the movement on the tech stocks of lately. Fundamentals can get overvalued and people don't pay attention for whatever reason. They just pile into a stock, a sector, or a country. But in this case, we're going to be looking at large picture index charts, which give you a picture of the overall environment, not any specific industry or specific stock of a country. So let's just get right to it. I'm going to share screen, and the first thing I'm going to do is show you this chart that Rosenberg pulled up. And basically, it's the G7. So you've got Japan, there, US, France, UK, Germany, the Eurozone in general, and Canada. So this is a productivity growth chart. And you can see, at least for the year, this is 1 year, year-over-year percent change in growth. Japan is definitely leading the charge, followed by the US. So there's a reason why their markets have gone up, and there's a reason why the US market has gone up, although one could argue more led by just a few stocks, as I've harped on before. Nevertheless, there is a productive growth environment in the US. Not so much for the other G7s, and guess who's in dead last place, and not just by a little bit. Canada is by and far experiencing the worst productivity growth. It's got almost negative 2% productivity growth over the past year versus anywhere in the average of -1 to +1.5 for Japan. So, we are really falling behind in growth. I won't launch politically, as I often do, but there's a reason, and why that reason is that Canada's falling behind. And some governments are just not worth the cost, as they say. So I'm going to bring you back now, and I'm going to start on the charts of world indices, and we're going to take a look at all of the different indices, the major indices out there, through, in many cases, ETFs that represent those indices. And, keep in mind that you just saw, for example, that, France wasn't doing too bad, and that Japan was doing very well, and the US is doing well. Those are things I want you to keep in mind from a economic point of view, from a fundamental point of view, when we look at these stock charts, which really don't have always 100% relationship to the fundamentals, but there can be some coinciding relationship. So let's take a look to start with the TSX. We just looked at it, the least productive economy in the G7s. So we're not including emerging markets in that chart we just looked at, but you can see that has most certainly shown up in the stock chart. Our government has been crushing the most important industry in the country, and it shows. So if you saw in my last videos, I pointed out where the US government was outperforming, or was underperforming, I should say, and the tables turned in since literally Stephen Guilbeault came in to the Ministry of the Environment. The Canadian gas producers are underperforming. their counterparts in the US. And this shows up because really a lot of our economy is based on the energy trade. And we are seeing a breakout by the TSX through about, I think it was about 20,800. And I've talked about this in my blog, but we're a long way off from that 22,000 high. And what's interesting is, well, there's probably a reasonable chance of us getting there, but you can see on the money flow index, which is momentum of money flow flowing into, in this case, the TSX, because this is an actual index chart, not an ETF, you can see that it's a bit overbought. So the chances are diminishing as to whether we see the 22,000 highs anytime soon. And this in an environment where a lot of major world indices are at least hitting, if not exceeding, their old highs, at least in the larger economies. So let's carry on. And in no certain order, I'm just sort of pulling them up as they happen. We'll be looking at these charts, and you can see this is the Chile. And now Chile, I've done this video before, by the way. If you look back, you'll see that I've gone through these exact charts in a prior video. And so some of these lines, these horizontal lines, are lines that I drew back about a year ago when I did my last World Indices video. And you can see the lines haven't changed. So support resistance on the Chile index is still there. It hasn't been able to pop through for any material period of time. It tried in 23, but it's been more or less trapped between 20 and 29. So if as a trader, I'd be looking at probably trying to buy closer to the lower end of the range, if it's going to stay in that range, that is. All right, so we'll take a look at the next chart, which is the emerging markets overall ETF. So this is taking countries like Chile, but also adding in all the other emerging markets, the Southeast Asian markets and the Latin American markets and whatnot, throwing them in one bundle. And you can see that index has been in a consolidation as well. The difference, though, is that there was a tremendous, downturn on the index, and there's a lot of influence by China in this index, by the way. And now it's been consolidating, being lifted up, not so much by China, as you know, but by some of the other components within the emerging market sectors. So you'll be seeing some of the emerging markets indexes as we rip through these charts. So just keep that in mind. But this on its own is not a bad pattern, because if it breaks out, and that's around on this is EEM. So if EEM breaks around 41.5, it looks to be as resistance. And that was pretty strong resistance. You can see it goes way back in time, many multiple touches. The upside is quite substantial. I mean, as high as the mid 50s. So I think there's opportunity if this index breaks out. And I think it's definitely worth keeping an eye on for all of us. Okay. Here's one that I really like, and I will disclose that we literally just bought a position in this index. Actually, today, as I'm recording this, we're buying some in our aggressive strategy. Very thinly traded, I should point out, this ETF. It's only got something like $150 million cap. Not the market, not the Israeli exchange, but this ETF. So just keep in mind it's pretty thin. But whatever the case, I mean, you know the story. There's a lot of war noise going on in that part of the world, and of course that caused their index to plummet. But it seems to be that there's probability of that war being resolved shorter term than maybe was originally thought. And the country has a huge presence in technology and biotech and that kind of thing, which is very hot, as we know, in North America. So there could be lots of upside. I'm not endorsed buying it. I'm just saying we do own a little bit of this ETF, not much, but we are legging in. We think there's a reasonable potential given the amount of risk. So a breakout like this is positive, but there's still tons of risk, because what could happen is the war may not go as well as everybody hopes. So keep that in mind. Australia. Now, this ETF has a massive lid on it. You can see going way back to 2021. It's never been able to be cracked. It's had a few, counter moves and downtrends, but it always seems to come back to around 24 bucks or something like that and then fall. So this is not an index that I personally would be interested in, especially where it is right now. Now, here's one that I do like, I don't own, but it's a great looking chart, is Sweden. Broke out of a consolidation, tested the neckline right there, and off it goes. Probably lots of potential on this one. All right, we're going to look at Germany, which I have traded before. We got out on the trade a while ago, right around here. It's gone a bit higher since we got out, but we like the trade. And I would think that it may reach its old highs of around 33 again, which is up here. It's around 30 right now. Not huge upside, but you know, not a terrible looking chart. Certainly, again, contrasting to the Toronto Stock Exchange, a much better looking chart. All right, Hong Kong. Well, you know, we know the story. China and Hong Kong, you know, suffering right now, and that shows up in this chart. There is some major support around the 16.5 on this particular chart. It has bounced off of this, as you can see, multiple times, going back to the COVID crash in 20, you know, the October sell-off in 22, and here we are again. It does seem to be trying to break back up again. Trend is down, trying to break up. It's a high-risk trade, you know, not for the timid, I guess you could say. So we'll now take a look at Italy, and this is truly a great chart. It had this massive wall at around 31. It broke it. It momentarily failed, but off to the races, and it's really doing well. Probably a little overbought right now, but not at all a bad looking chart. All right, we're going to look at Japan now. Now, Japan, as you recall on Rosenberg's report, is one of it's actually been the highest growth productivity country in the world over the past 12 months anyways, and it shows on the chart they're coming into their old highs, and they're really coming from a very low point, unlike the S&P 500 that, you know, yes, it's second in the race for productivity, and it's at all-time highs, but you know, where the S&P came from versus the Nikkei came from, well, the Nikkei was, this particular index was down around 45 or so, 40, I guess it's 47 if I look properly on the chart. It's 69 right now. So that's a much larger rally than the S&P has had. So it shows up, again, here's a connection between the fundamentals, the productivity, and the stock chart. Do I think it'll get through? Well, it's probably a little overbought right now. You can see here's the moving average down here, the 200-day, 40-week. It's at around 62, and the stock's at 69. That's, you know, 15+%, which my rule tends to say that when things get over 15% for an index, they're starting to get overbought. I think the Japanese market is a little overbought, might pull back, but eventually I think it has the potential for breaking through this lid or this old ceiling. We'll see. Next, we're going to look at Belgium, and not just good for waffles and rally racing. If you like cars, I love the Porsche rally races, GT3 series that they do out in Belgium. You know, put 911 GT3s through their paces with very harsh conditions, and it's really exciting to watch and hear the sound of those magnificent engines. Well, Belgium's also known for cyclocross racing, which is another thing I'm very interested in. I'm a cyclist, and they're probably the most famous place for cyclocross racing in the world. They're a harsh condition country, and the stock index, as you can see, has been trapped at $19. This is an ETF, so it's reflective of the index, and it really hasn't shown any sign through 23 or 24 of breaking that. So I'd give this at best a 5 out of 10 chart, but still love the country. Who doesn't like all the great treats that come out of Belgium? All right, Switzerland, talk about treats, the land of chocolate, and watches and other fine apparel. Well, these guys are seeing their index struggle again. The old highs of 22 were a bit higher than right now, but you can see on my lines here that I drew again about a year ago. Those lines are still holding, those support resistance lines. And what might be interesting about this video is that I am using the lines from a year ago, and they're holding. So support resistance is real. It's real people trading, and it does project into the future. And breakouts are very legit too, because as you'll see on these charts, some of the lines that I drew a year ago, we're seeing breakouts, and now we're seeing massive upside. So here's I drew this consolidation a year ago. I drew this downtrend. what I said at the time is it's got to break out of the consolidation, which it looks like it has. This is Malaysia, and it'll probably test the trend line soon. Again, I'm going to give this a 6 out of 10. It's not something I'd be jumping on, but it's all part of that emerging markets index we were looking at before, and adding to the upside in that index. We could see a breakout. So Netherlands, the Netherlands has we've had some good politicians come in, the very favorable politicians for progress and all that kind of thing, and it's showing on the chart here. They're doing well, coming into their old highs. Would I buy this right now? I really hate buying a stock that's had such a good move and is now hitting a major old high, which is going to be major resistance. But it's encouraging, and I would say that hey, if it came back to this old neckline or anywhere near it, it might be worth a purchase, because the trade then to the old highs would be much more favorable. At this point, it's pretty close, and I wouldn't jump on the trade personally at this point. All right, this is Austria, and the index, home of Arnold Schwarzenegger, I believe, and another person I admire very much. It's broken out. This is this black line I drew a year ago, and it definitely was acting as resistance, and now it's acting as support. It broke out and is acting at support. It could get back to its old highs, which is somewhere around $24. It's trading around 21 right now. So mediocre upside, but not a terrible looking chart by any stretch. Let's look at Spain. And again, as a cyclist, that's a mecca place to visit for guys like me who love to ride their bikes. It's been in a very choppy uptrend. It's supported by the moving average, as you can see. It's actually not a bad looking chart. So if you're looking for international diversification, this is probably one I'd consider as one of many to add to a portfolio. But it's a good looking chart. Now, this is France, and you might recall France was, I think, number 3 for productivity in that list we looked at the beginning of the video, the productivity list by Rosenberg, and you can see it is breaking out its old highs. This is very bullish for this index, very bullish looking chart. Everything's going right for it. You can see a bullish crossover with the moving averages. I think there's a very good story here with this particular index as far as technicals go, anyways. And Singapore, very sideways market. So we're again getting back to some of these going nowhere fast type of looking stocks. Taiwan. It's sideways market. Again, remember, I drew these lines some time ago. Looks like it's breaking out. And that would target, again, the old highs, which would lie somewhere around 51, 52. It's around 46 right now. Okay, upside, not bad. And United Kingdom, the UK. Is it, so this line, again, I drew it a year ago, and you can see the index is still struggling right there. Like, you could say, well, that looks like a breakout, but honestly, I'd argue with that. It's a breakout, but not by much. So it's not a chart that I'm particularly interested in until we see that breakout be sustained for a while and gets a little bit of legs behind it. It's really not much of a breakout. So I'm cautious on this one, although it has potential to be a very good play, but I would not be a new buyer on this index just yet. Mexico. Now this is an economy that is doing well in the emerging markets space. They're getting some business from China, given all the stuff that's going on in China and politics and stuff. So there's a little bit of favorable attitude towards the Mexican index, and you can see that on this chart. You can see that there's a line that I drew a while ago. I said, oh, gee, old highs will become support, and that's what's happened. It's become support. We could extend this line now, and but it's all very positive looking as far as this index goes. So I think this is another one of the attractive charts that I've shown you today. South Korea specifically, trapped in that nowhere land where it just can't break a neckline, which is around $65 on this ETF. You know something, when you get a series of higher lows and flat highs, that's a consolidation, but it's not a negative thing. And again, if this index breaks out, you can see, it attempts at the odd tiny little breakout, but then it fails. If this index can break out legitimately, look at all the air above it before it hits its old highs. The old highs were around $87 to $88, and it's currently around 65. Well, what if it, I should say 60, 63 or 64, my eyes were not working there. So, what if it breaks out and hits around 67, which to me would sound like more of a legitimate breakout? Then my target would be 87. So a massive potential on this one, probably worth keeping your eye on, but conditional upon a legitimate breakout. Brazil, now I will disclose, we own this one too. We've owned this for a while. We liked to play the trend, or sorry, the support resistance pattern on it, and we have traded this multiple times over the years. We entered into it, and this time we're holding it, and we're seeing kind of an attempt to break out, as you can see on this chart. It did pull back to the neckline, but once again, it's breaking out, trying to break out. It's very early to tell you that it will break out, but Brazil, the index itself is something like 30%. I may be wrong on that figure. You can correct me if you wish in the comments, but it's something like a third or 30% of the index is in Petrobras, which is the oil and gas company. And I'm bullish on oil and gas coming into the spring. And these guys are very overweight in that particular stock. So it will be interesting to see, because if oil moves at all, you'll see this index move. So we'll see. As I said, we're in the stock. We haven't sold it out at resistance like we have a couple of other times in the past. And just based on our view on oil, we are giving oil a chance to move. And now let's look at China. We looked at the Hong Kong index, not a lot of differing stories here, really, in a downtrend. Has found support in the past, down around current levels, is trying to bounce up. This neckline that I drew last time I did one of these videos failed. So that's going to act as resistance, which is around $24.50. If that breaks, then you've got the trend line and the moving average. Okay, so there's lots of guns pointed at this index right now. We are in a China ETF right now, and we're trying to trade it for a near-term move. I don't necessarily recommend this for longer-term investors, but if you like a little bit of more speculative, aggressive action in your portfolio, not a bad potential, given that it got so oversold just recently. The valuations, by the way, on some of these Chinese tech stocks are amazing. So again, though, the market doesn't care about that. The market cares about what the market cares about. It doesn't matter what you and I think about the valuations, but there are some very, very cheap stocks, especially in the tech sector, when you compare them to our tech stocks. And one could argue that the quality of some of the Chinese tech stocks are very, very high indeed. They're not sluggards by any chance. They're very good companies. So be that what it is, the charts are all that really matter to me. Anyways, Colombia. Colombia broke out, is now pulling back close to the neckline, and probably has potential to get into the high 20s. Lots of volatility on this sucker. Like look at the trades. Your grandmother should not be in this stock. It's not for the timid. I think we've only got a couple more to go. So India's been a great story. Again, another one of these emerging markets that's been taking away some of the market share from China. Growing economy. They're involved with more than just labor. They've got a vibrant industrial sector. They're moving into some technology. So they're a really interesting story, and the index here shows it. I wouldn't mind it if they pulled back a little bit before I bought, but it's not a bad story at all as far as world indexes go. This is the S&P 500. So we're coming to home base on the behemoth, and you can see that it's crazy overbought. Like just looking at this, there's the moving average. There's how high it is. You can't argue with the breakout. And by the way, I drew this line ages ago. You can't argue with the breakout. It's legit. It's a bull market to be sure with the S&P 500, so long as I think it's 4,200 on the actual index. This SPY ETF is 460. Doesn't matter so long as the old breakout point doesn't get cracked, and I don't think it will. I do think it'll pull back because it's just like, look at that line. It's just been straight up. It's so far ahead of its moving average. And, you know, again, when we look at some of these momentum indicators like MFI, it's just out of control high. It's so high that, you know, this market's so overbought based on, you know, the Magnificent Seven and maybe a few other stocks that it's going to pull back at some point. And if it does, massive opportunity, because this is a great looking chart, to tell you the truth. It just is overbought right now. So I'm a fan of what they've done. And they show up in the productivity stats that we just showed you at the beginning of the video, that the US is second only after Japan for year-over-year productivity, and it shows on their chart. So back to the TSX, which, as you know, is the least productive country in the world, and the chart definitely shows us that. So I hope that helps. So the productivity stuff is just one of the fundamental tools that I read up on. I'm not a fundamental guy, but I like reading this stuff. And, you know, from everything I can see, that most of these charts we just looked at kind of lined up with the productivity figures for the seven that we looked at the beginning. And that is that if you had mediocre productivity, you have mediocre stock chart. If you had good productivity, you had an emerging stock chart. So thanks for watching, and we'll be back next week with something different. Thanks for watching, and we'll keep on giving you new ideas to explore.